Hi, everyone. Thanks for joining this quarter's presentation. I'm Ryan Lehman, iCM's Director of Investments, and I'm going to be your host. Over the next 20 minutes or so, I'll be walking through the state of the closed-end fund market, as well as providing an update on the performance and positioning of our tactical income strategies that extensively utilize closed-end funds as a part of their tactical asset allocation. If you do have any additional questions or would like more information on our tactical income strategies, please feel free to reach out to a member of our advisor services team. We'll have all that contact info available at the end of the presentation. So with that said, let's go ahead and jump right into things. So just to start at a universe level, discounts did move out a bit on the quarter. This largely occurred in March as concerns over the US-Iran conflict sent volatility higher, equity markets lower, and credit spreads wider. The result was broad widening of just about 60 basis points for the average fund, with non-US stock funds and taxable fixed income funds both moving out by more than 100 basis points. Munis were really the lone exception here. They actually saw their discounts narrow by around 100 basis points on the quarter. However, that narrowing did largely occur in January, where high demand for longer dated munis did help support prices. Now, if we look at how the discount environment changed on the quarter, we do still have around 78% of the universe trading at a discount to NAV, which is generally in line with the long-term average. So no real change here. However, we did see the distribution shift a little bit to the left. So this reflects that discount widening we discussed on the last slide. So although we didn't see funds moving from a premium to a discount, those discounts did get more attractive in the first quarter. So switching gears a little bit here, taking a look at some of the key drivers of closed-end fund discounts. We're going to start with interest rates. So interest rates in closed-end funds tend to exhibit a negative correlation, meaning that when rates decline, closed-end fund discounts tend to narrow, and then when rates rise, they tend to widen. This is going to typically occur with one caveat. It's going to be when you have rates declining due to an event of extreme market stress. So think COVID pandemic, financial crisis, you're going to tend to see that relationship turn positive. So just to expand a bit on what we're looking at on this slide, so we're looking at the yield on the 10-year US Treasury, that's going to be in blue, and then the average muni bond fund discount, that's going to be in orange. So here we're using munis because they do tend to carry more duration and they're going to be more interest rate sensitive than the taxable side of the closed-end fund market, which is going to be more credit oriented. We'll take a look at that next. So just looking at Q1 though, it was a bit of an anomaly when you looked at a purely quarter over quarter basis because rates did move out from the start of the year to March 31st, but the majority of that move, it did come in March alone. So as a result, what we saw was very strong performance from muni closed-end funds to start the year, but they did give a bit of that back along with all other asset classes following the start of the Iran conflict. This is kind of what you see in this slide. So next, taking a look at the relationship between discounts on taxable bond closed-end funds and credit spreads. So unlike the last slide, no anomalies here with rising concerns around private credit and then additionally the Middle East conflict. Spreads for U.S. high-yield bonds, they did move out. They were at a low of 247 basis points in mid-January, and they jumped to nearly 340 basis points by the end of March. As expected, this negatively impacted the majority of taxable bond closed-end funds, which do tend to be heavily invested in high yield bonds and bank loans. As a result, we saw discounts widen roughly 130 basis points during the quarter to 5.8% below NAV. This is a pretty notable reversal from what we saw at the start of last year when the average fund traded at less than a 1% discount to net asset value. And then lastly, here we're going to see the relationship between equity market returns and broad closed-end fund discounts. So in terms of this relationship, behavioral finance, or the tendency for investors to over and underreact, is going to play a primary role in driving closed-end fund discounts. And as many of us know, the closed-end fund market, it does tend to be very retail-driven. And that's essentially exactly what you see on this chart. Declines in equity markets and high volatility environments are going to tend to cause closed-end fund discounts to widen, while periods of strong returns or low vol tend to cause discounts to narrow. So similar to the interest rate slide, again, you're going to see a little bit of a short-term anomaly here. So stocks were generally well behaved to start the year. However, following the start of Operation Epic Fury at the start of March, the S&P slid by around 5%. That's not necessarily reflected in the one-year performance figure on this slide. That said, closed-end funds, they essentially behaved as expected, with discounts widening by roughly 60 basis points, which is now more than 1% or so wider than the long-term historic average. And I think this is a good transition to start talking about our flagship TICE strategy. So first, looking at portfolio attributes, our closed-end fund exposure, it did decline in Q1, but this was largely the result of a handful of mergers and consolidations, which is going to directly benefit shareholders, as most of the funds, when these corporate actions do occur, they're typically merged or liquidated at their net asset values. So what this resulted in was a reduction of 5% in our total closed-end fund exposure, which stood at 31% as of March 31st. Now, from a discount standpoint, we ended the quarter with an average discount of over 10% for those positions that we do hold in the portfolio, which is roughly double the current universe average. So some really attractive opportunities that we still are finding. And then as of quarter end, TICE was offering investors a distribution yield of just over 4.5%. This is generally in line with what we saw at the end of last year. Now, to speak to where we're finding the greatest opportunities, here what we're looking at is the closed-end fund versus ETF breakdown for each sleeve of the portfolio, along with the average discount of the closed-end funds that are held in each sleeve. What you're going to notice is we're clearly finding the least amount of opportunity in U.S. equities and taxable fixed income funds, with an 18% and 71% allocation to ETFs respectively. For U.S. equities, this has been relatively high for much of the last year plus, outside of the tariff-related volatility in April. However, key observation to make in regard to our U.S. equity allocation is that despite the universe not looking great as a whole, the funds we are invested in are trading at very attractive discounts, which averaged more than 14% below NAV. And then similar to U.S. equities within taxable bonds, the funds that we do own are still trading at attractive valuations with an average discount of around 11%. The area this area has become more increasingly attractive with that move out in discounts. We do need to see a little bit more before we would start adding meaningfully to this space. Now, we still are allocated about 50-50 between ETFs and closed-end funds in the international and muni sleeves. However, we've seen some meaningful discount narrowing in both areas over the last 12 months or so, which has led to some profit taking and an overall reduction in our closed-end fund exposure. We also, like I mentioned earlier, saw a handful of mergers within our muni holdings, which also reduced our total closed-end fund position. So next, taking a deeper dive into the performance for our TICE strategy. Here, what we're doing is decomposing the strategy's returns into the three core building blocks of returns. So those are capital appreciation, dividend income, and closed-end fund alpha. In Q1, the strategy did post a negative return. However, it did still outperform its blended benchmark on both a gross and net basis. This was primarily driven by the yield component of the strategy, which contributed more than 100 basis points to return. The closed-end fund alpha component that was negative, which was largely driven by discount widening in March. However, this could have been a much more significant detractor had the strategy not been so conservatively positioned as we entered 2026. And then, like I mentioned just a second ago, the strategy did see declines in Q1. However, it did outperform its blended benchmark. And as we look throughout the history of the strategy, you're going to see strong returns over all trailing periods. In particular, since the composite's inception in October of 2016, it has outperformed its blended benchmark by 171 basis points annually on a gross basis. And then from a risk standpoint, since inception, TICE has exhibited a standard deviation that is a bit higher than the blended benchmark. This is going to be driven by the higher volatility nature of closed-end funds. However, investors have been amply compensated in the form of that excess performance that we just talked about. And then for the remainder of the presentation, we're just going to switch gears here and discuss our TICE Alpha Opportunity Strategy, or TAO. And for those who aren't familiar, TAU's a unique set of strategies that's going to combine our TICE closed-end fund alpha strategy with a portfolio of undervalued assets, which we like to refer to as high conviction tactical assets. Everything that we've talked about thus far, that's going to directly apply to the first half of the portfolios, which is just an asset-weighted version of TICE. In the next few slides, though, what I want to touch on is where we're finding value from an asset class standpoint for that second portion of the TAU strategies, and then how all this is translated into performance. So starting with our long-term return expectations, we have seen some slight increases across the board with markets generally declining in Q1. The lone exception, that has been commodities, where our future return assumption has essentially been cut in half. And this is largely due to the Strait of Hormuz closure. Energy prices have soared, leading to gains of between 20 and 40% for various commodity indexes, depending which one you're looking at. And then on the fixed income side, we've also seen an increase in our future return assumptions here, largely due to rising interest rates and widening credit spreads. That said, IG and high yield corporates do look slightly more attractive than core investment grade fixed income at this point, but only from a pure performance standpoint, not in terms of your potential risk adjusted return, because spreads are still pretty close to historic tights there. And then the way this all translates into the portfolio's asset allocation, that's shown on the two pie charts here. So on the equity side of the portfolio, we did make some changes within the portfolio that were beneficial to performance. While EM value and commodities, they were held constant, we did reduce our allocation to international value to fund a small allocation to US small cap value. This was largely due to the increasing attractiveness of small value stocks and then the declining return potential for international value stocks given their extremely strong performance in 2025. And then on the fixed income side of the portfolio, no changes of note here. We continue to maintain that somewhat of a barbell position. So you're going to see EM local bonds, that's your risk asset on one side of the portfolio. And then we're balancing that out with an allocation to short-term treasuries as well as a small position in long-term treasuries. So getting into our rationale for our high conviction assets, let's go ahead and start with equities. As you can see from the chart on the left, US stocks broadly and in particular growth stocks continue to look expensive. This comes despite their pullback in Q1. Conversely, small value names have seen valuations fall below their long-term fair value, while also being supportive by very optimistic earnings growth. One note here, the expectations for earnings growth, they do appear to be a little bit outsized for the next 2 years, especially compared to US large caps. But I would say one thing to keep in mind is that these are growth rates and we are coming off some pretty distressed levels. So that's going to explain that large jump in earnings. Now you combine these two factors though, and it speaks to our decision to take a small step into the asset class. Then our largest positions, EM value and EFA value, they still remain extremely attractive despite last year's strong returns and a positive start to 2026. Here you're going to see non-US value stocks roughly 18% below fair value, while EM value sits at just over 30% below fair value. Next, to touch on commodities, we saw a massive rally in commodities indexes following the energy run-up in March, which we touched on already. This has essentially cut our return expectation, which currently sits around 4%, to its lowest level since the end of 2022. As a result, don't be surprised to see our commodities weight reduced at some point here, given that we're able to find more attractive return opportunities across a variety of domestic and international equity asset classes at this point. And then moving to fixed income, with that sell-off in risk assets and renewed strength in the dollar, that weighed on emerging markets local bonds, which has served to slightly increase our outlook for the asset class. As a result, we do continue to find EM local bonds relatively attractive. This is going to be due to a combination of their positive carry over US bonds as well as their exposure to non-dollar currencies, which do continue to appear attractive. And then lastly, we have treasuries. This slide shows the curve steepness of the 10-2 segment of the curve versus the entirety of the curve, the 32 segment. In both cases, you can see that the curve has been on a somewhat prolonged steepening path with the depth of flatness or inversion coming in June of 2023. Since then, the curve has been steepening and has continued to do so in 2025. In fact, the 10-2 segment steepened by 35 basis points in 2025, while the overall curve steepened by about 80 basis points, meaning that 2-year rates fell by more than the 10-year, which fell more than the 30-year. The fact that most of the rates movement was at the short end of the curve, Treasuries did not benefit fully from the duration impact of a parallel shift in 2025. The other takeaway here is that while the front end of the curve has yet to return to average steepness, the overall curve, particularly the back end, that pretty much has at this point. This could lead to an additional tactical opportunity with the long bond as the year progresses. The only other thing to note here is we did see a bit of flattening in 2026. This was largely due to the uptick in expected inflation due to the rise in oil prices we saw, more so at the short end than the long end of the curve. But we have seen the curve flatten a little bit, but in terms of the shape, looks much more attractive than it did just a couple of years ago. And then to finish up with attribution and performance, here you're going to see the year-to-date performance for our high conviction assets. All three outperformed the policy benchmark on the quarter, with commodities posting a near 30% gain versus a 3% loss for the bogey. This translated into very strong performance, as we're going to see on the next slide. And then performance for our fixed income assets, that was generally mixed on the quarter. Our largest position, short-term treasuries, marginally outperformed, while EM local bonds were a detractor. The majority of the losses here, though, for EM bonds, those came primarily from a renewed strength in the dollar amidst that conflict in the Middle East. And then looking at returns, this resulted in strong results on the quarter across the board for all of our gross composites. All models posted positive gross returns despite losses for all their benchmarks. Performance for the more aggressive models were particularly strong, with the 80-20 strategy gaining 2.67% on a gross basis compared to a 2.61% decline for its blended benchmark. Now, if we look since inception, that's going to go back to April of 2020. Income ops has gained nearly 6% annually compared to a gain of 2% for the blended benchmark. Performance here, that's been largely supported by our closed-end fund alpha sleeve, which added meaningfully to returns for just about every calendar year except 2022. We also saw a benefit from our short treasury and EMD positions, which have added pretty significant value over the last year, with the exception of EMD trailing a little bit on a year-to-date basis. And then for Tau 80-20, you're going to see excess returns of just over 250 basis points annually over that same inception period. Unlike income ops, though, this was largely driven by our positions in our high conviction tactical sleeve, particularly commodities and non-US value assets. So they provided a significant level of downside protection in 2022, as well as thus far in 2026. And then our non-US assets also benefited the portfolios due to those strong results that we saw in that weakening of the dollar that we saw in markets last year. And I think what all this really does is just highlights an important component of Tau, and that is its ability to benefit from these different sources of return. So you have your closed-end fund alpha as well as your undervalued assets, and they do tend to run in varying cycles. And this really helps us to provide competitive results across a variety of market environments, which is precisely what we've seen in practice. And that does it for this quarter's TICE Tau strategy update. If you enjoyed the presentation, please feel free to like, share, and subscribe. Also, if you've got any questions or would like to learn more about our tactical income strategies, please feel free to reach out to a member of our advisor services team. You can see all of their contact info as well as our website address on this slide. Thanks for watching, and I hope you'll join us again next quarter.